Welcome to the Cash Flow Project Podcast. Are you looking to better your financial situation by increasing your cash flow? Too busy to hunt for real estate deals or don't know where to start? Then you're in the right spot. Join us as we dive in and talk about investing for cash flow using multifamily real estate.
Welcome back to another episode of the Cash Flow Project Podcast. I'm your host, Vince Gethings. Here with me today is Amy Sylvis, who is the founder and principal of Sylvis Capital, a real estate investment firm that invests in large commercial real estate properties in emerging markets throughout the United States. Mainly the Southeast and Midwest is her playground. She's coming out of LA, so we get to talk about some investing in out-of-state investments there. Right before I hit record here, she dropped on me that she's only been on the active side for 3 years and has amassed a $96 million portfolio of assets under management. It's just under 750 apartment units, got some flex space and some other types of assets in there, assisted living and stuff like that, or not assisted living, it was 55 up. So got the diversity in there of that, but it is crazy. 3 years active side, 96 million. It's probably the fastest growth we've seen on this show that I can think of in 130 episodes. So I'm really excited to see how Amy has achieved this and what's next. So Amy, welcome to the show.
Hey, thank you so much for having me. I've been really looking forward to speaking with you.
All right, let's get right into it. So we're recording this. It's the beginning of the new year. It's actually January 6th, 2023. We just finished out 2022, which was for most people, their best year ever. Most people I'm talking to for real estate. So how was 2022 for you?
Yeah, same. It was such an incredible year. You know, the typical bread and butter multifamily that I've historically been a passive investor in, and years prior active investing, that became a little bit more difficult as the Feds raised rates. But the great news is it pushed me to really understand and diversify my portfolio to figure out where the opportunities were. So to your point, jumped into flex industrial as a diversification play, jumped into 55 plus, brand new development. So yeah, it's been really exciting, very lucrative, and most importantly, allowed us to serve a record number of tenants and residents.
Absolutely. I want to get into that flex use space here in a minute, because that's interesting. I know it's on a lot of people's radar, especially on 2022. That became one of the kind of the buzz niches that people were getting into. But before I get there, let's talk about how you amassed such a large portfolio in 3 years. So, you're saying you did passive investing for some amount of years before, and then you made the jump to active. So let's talk about that. Like, how'd you go from the whatever you're doing before real estate into the passive side, and then the passive side into the active side? Like, what did that look like? How'd that happen?
Sure. So yeah, my story is a little bit unique, and I'll give you a little overview, and however you want to dive in, you let me know. But essentially, I knew I wanted to get into this space starting in around 2009 after reading Rich Dad, Poor Dad. Raise your hand if that was your journey as well, reading that little purple book. But, and as I tried to get into the active space in the early 2010s, unfortunately, my health knocked me out after several attempts. So it's actually 10 full years of trying to get in this space and being a passive investor in the meantime, until I finally jumped into that active space. So it was a long journey, but passive investing, surprisingly, which wasn't on my radar, served me incredibly well in terms of education, networking, and helping me to really understand how to do this well once I jumped over to the active side.
Okay, so had some health issues, and then you overcame that, which is tremendous.
Thank you.
And then your first passive deals, what did those look like?
Yeah. So first passive deals, found them through networking in the space with other folks that were active, and vetted the operator. It was a little city that wasn't as well known back in 2010 and 2011 called Chattanooga, Tennessee. I think it's a little bit more familiar to some people as that market has grown exponentially over the past 10 plus years. But yes, smaller kind of 50, 60, 70 unit deals where I was able to passively invest a little bit of money that I had amassed. And thankfully, be able to ask questions of the operator and sit in on some property management calls to really just gain exposure and see how to do this game right.
Okay. What did you learn from the passive investing side? You said you got to learn kind of riding in the back seat, so to speak, of those deals.
Yeah.
So what are some of the things that you learned in those periods of time that you were a passive investor?
Several key takeaways. And the first one was, as a Los Angeles native, how to pick a market. I think we all agree, those that are in this space understand how much a market can really accelerate your returns. And to be honest, I'm a coastal gal. I'm well traveled, but in terms of really looking for a space to invest, pour in my money, and to predict where we might see great returns because of great net migration, economic growth, it was something I wasn't all that familiar with. So understanding that from the operator's standpoint and the several deals that I passively invested in was incredibly helpful. Also seeing some property management issues, that can be a tough thing to do in the commercial real estate space. Not all property managers, unfortunately, are capable or willing. There are always changes, things like that. It was great to see some of the struggles that this operator went through and how he handled them, which has really given me great lessons to be able to apply to my own properties here on the active side. And then finally, how to treat residents and tenants well. I think we all know of slumlords and people that just really look at residents as simply a line on the rent roll or part of a P&L. But I really was able to see from these operators I worked with how you can treat residents and tenants well and also do well for your investors. So a nice little, do well by doing good type lesson.
Mm-hmm. So you mentioned that market research is one of your strengths on your team now. What are some of the things that you look at, or what are some of the tips that you have, or your secret sauce when you're going in to look for markets, like strong markets or those emerging markets? What are those specific things that you're looking for?
Yes, you're right. I can't get enough of market research. It's kind of like a little detective treasure hunt, if you will, that I love spending time on, mostly because it benefits our investors and, of course, my own investment so much. So as I mentioned, population growth, big driving factor, right? We want demand, whether it's industrial real estate, multifamily. We'd like to know where folks are moving. So resources such as the U.S. Census Bureau, U-Haul publishes on the residential side a list of their top markets where people are moving to. So population growth is one. Second, job growth and looking at the unemployment rate, and not just in absolute terms, in terms of where jobs are growing or where unemployment is low, but how does that relate to the national scene? So if a market I'm taking a look at has a 5% unemployment rate, that sounds decent. But if the US is at a 3.5% unemployment rate nationwide, maybe not as attractive. So we really try to take a look at those numbers and that data. I could go on, but my third biggest one is taking a look at the industry or the employers, which industries they're a part of, and understanding that diversity. We love markets that have a nice mix of whether it's manufacturing, technology, even government jobs that can be nice and stable and recession-proof, if you will, or recession-resistant. So really making sure there's a strong economic base and diversity and breadth there can be incredibly helpful when choosing a market to invest in. Yeah,
absolutely. Job growth, population growth, income growth, and the industries. Yes. One of the best things on the my takeaways that I always keep in mind, and I always try to relate when you're looking at who the top employers are and the top industries are, is you want to really make sure that you're not in the one horse town. So, because when times are good, Texas is really popular for this, for their oil and gas industry. Like, Midland, Texas, and Odessa. Some years it's absolutely the best place in the world, and then other years it can dry up like that because you're in a one horse town and the horse died. So that's one of the things I see a lot of newer investors. They kind of get caught up in like, oh well, Costco or Amazon is building a thing here and they're employing 700 people. I'm like, but that's the only thing in that town. That's the only thing that town has. So if they decide to pick up and move, you're toast. So I think that's very important, is that having that diversity in the industry there as well. All right. So you learned all this stuff. You start developing your own kind of brand and desire to do your own thing. So what was that jump like going from the LP side to the GP side or to the sponsor side of the house? What are some of the challenges you had to overcome? What was that first deal you did and lessons learned?
Yes. It was exciting, but also scary, taking other people's money, being a good steward of growing money. And to your point, picking the right market, the right deal, and operating well was intimidating. But what I soon learned after hiring a coach and a mentor, which I think was very pivotal for me, especially because I didn't come from this industry. I came from biotech, was finding a team, understanding that this is a team sport. And I'll admit, I'm a go-getter. I'm one of those people that likes to get things done. If it's going to be done right, I'm going to do it myself. But strong lessons learned in my mid to late 30s that really having a team full of people that have like-minded values and expertise and experience different than mine, but complementary, absolutely rocket launched my path here on the active side. So that's probably one of my biggest takeaways.
Okay. So what was that first deal though that you did?
Yeah. So the first
family or
it was a 58 unit in Clarksville, Tennessee. So about an hour northwest of the booming market of Nashville. Nashville's incredible, but we really wanted to take advantage of some of the affordability issues that were occurring in Nashville proper and folks moving out a little bit further out of town to have more affordable housing, but within commuter distance to take advantage of all the incredible jobs that were popping up in the metropolis.
Okay. And do you still own that or have you full cycled that deal or?
Yeah, we just went full cycle actually a few weeks ago. So we held it for approximately, I think, 19 months. It ended up being, it was supposed to be a 3-year hold, but we were able to reach our returns and our rent pro formas very quickly because, again, the market research paid off and it was such a booming market. So it was time for us to return in money, the original investment to our investors, of course, and profit, and keep up the velocity of that money and move on to the next deal.
Okay. No, that's good. Congrats on that. And
thank you.
So we started this show talking about 2022, ending 2022 and kind of going into 2023. There's a lot of speculation about where we are in kind of the market cycle and what this year holds for us. What is your team doing? How are you digesting the information that's coming from the Fed and the government and the markets themselves, market movement? And what are some of the things that you're doing as we go into 2023 here?
Yes, there does seem to be quite a bit of uncertainty. And I know a lot of our peers in the group are pencils down or are wary to do deals, but we are still extremely active, knowing that, of course, we need to have layers of mitigation strategies and, of course, a huge heap of conservatism as we move forward. Who knows what the Fed is going to do? Quite frankly, it's out of our control. They seem to be really following a path of continuing to hike, and we think perhaps it'll slow down. If not, they may capitulate in the latter part of the year. But regardless, our conservative underwriting and making sure we're choosing these recession-resistant markets with the diversified employment base, and of course, buying at a good cost basis, making sure we're not overpaying, but we're paying on actuals as opposed to what we might be able to get when we increase rents. All of those things allow us to be continually buying and bullish while still feeling very conservative and a good steward of our investors' funds. So we're excited to keep going, both in the multifamily space and in some other areas such as flex industrial in 2023.
All right. And so you are buying.
We are buying.
You are buying.
Absolutely.
That's good. All
yes.
right. And one of the things we saw in your bio, and I was quickly looking over it before we jumped on, was your recent acquisition of that flex space. So, and you didn't go small. And that one, it's over 200,000 square feet of industrial and flex. So that is not small. That's a big jump into flex. So where did that deal come from? And, how'd you structure it? What's the plan on it? Because a lot of people have been talking about flex space and industrial and, getting to that the last year or so. But you definitely went off the deep end and bought a huge place. So I want to see kind of how that deal kind of came about.
Yeah. Well, the overall strategy was really diversification, number one. I'm heavily invested in multifamily. I invest my own funds in these deals as well that I do. So I was really looking to take advantage of several trends, one of which is onshoring. We are starting to see companies, for a whole host of reasons, whether it's the pandemic, whether it's geopolitical uncertainty, whether it's supply chain issues and just simple logistics, onshore manufacturing, storage into the US. And Kansas City, Missouri is, interestingly enough, really well poised to take advantage of this. And we've seen companies locate there. So central part of the US, very easily accessible. And of course, low cost of living. So all of those things came together to make it a very attractive asset. But it was really this intention of wanting to diversify, wanting to get into this industrial asset, and then finding great co-GPs, co-asset managers that were familiar with the area where I wanted to invest. So found some partners, as I mentioned earlier, that had a need and a skill set different than mine, and decided to serve our investors that way by finding an asset in the flex industrial space. So it's been very exciting. Happy to dive into the business plan or anything else you'd like to know about it.
Yeah. What's the business plan?
Yes. So, for those who are familiar, triple net lease is a pretty amazing and different animal than the multifamily space. So, our tenants are paying the taxes, the insurance, and the repairs and maintenance. So unlike multifamily, where, at least for us, where we go in a kind of a value add strategy, the value add strategy here really is we've got one vacant space that we're going to lease up in an area where there is tremendous demand. And our leases, as they expire, they're usually 5-year long leases. As they expire, they're well under market. So bringing them close to market, huge value add. And then simple things like repaving the parking lot, making sure the chiller system is, up to speed and doing what it needs to do. And that's it. It's a pretty straightforward, simple plan that's refreshingly less complex than multifamily.
No, absolutely. What is the long-term plan? Is this going to be like a typical 5-year syndication hold? Is it a longer term hold?
Typically, it's going to be a 5-year syndication hold. So yeah, that's what we're planning for this one as well. Market cycles, especially in any given city, can be on a 5 to 10, sometimes even 15-year cycle in terms of emerging, being saturated, et cetera. So we like to tell our investors we're going to hold for about 5 years, get them the cash flow, the cash on cash annually, and the return they're looking for by selling. So that'll be the length of the hold, most likely.
All right. I like it. And you've also, that wasn't your last acquisition. Your most recent was the 55 and up community. So again, further diversifying your portfolio. Tell us a little bit about that deal. The last one, the 55 and up.
Yes, that's a 150 plus unit, 55 plus community right outside of Fort Worth, Texas. And it's a community that really is average income. It's almost hard for me to say is above $100,000. I mean, this area is booming, incredible school districts, and there's almost no 55 plus communities. There almost are no 55 plus communities in the area, yet we're seeing tremendous demand from it. We've done a lot of market research, again, partnered with a team that's local on the ground that has experience in the greater Dallas-Fort Worth area. And it is a brand new asset. So that's new to me, not to this team I partnered with, but 2022 build. So we'll be involved in the lease up process. But as many of us have seen in the multifamily space with older assets, expenses have shot through the roof because of inflation. And so I thought it would be a really exciting hedge for us to have a newer build, which will inevitably have less repairs and maintenance expenses, less of a value add component, but that's okay. We're able to still get great returns once we stabilize the property.
Yeah, absolutely. That's good. So that one, rather than, because I see a lot of people get this, a lot of investors will get this shiny object syndrome, and it's hard to say.
Yes.
Where they're like, oh, we're going to do multifamily, and then now we're going to do flex space, and then now we're going to do storage, self-storage, where you were able to kind of navigate that. And it seems like you did it by partnering with people that already had experience in that thing. So you weren't going out and like learning flex space, all by yourself. You just partnered with a team that already has some experience in that, or maybe they're experts in it probably. So is that what you did? Am I correct in that?
Yeah, no, you're absolutely right. I mean, there's definitely a ton of self-education prior to making the decision to go into these kind of different sub-asset classes of commercial real estate. But yes, working with people that have that experience. I'm not interested in, someone's first rodeo, for maybe lack of a better term, but someone with proven experience where I can add value to them with their existing skill set is really how I like to do things.
No, I like that. I think that's probably the best way to mitigate risk, especially on your first. So just some of the same ways you were LP first, and then a GP, is you got to ride along, kind of soak up everything you could, and then you might do 1 or 2 or 3 of these flex use deals, and then find out like I know enough to go do this on my own. And I think that's a perfectly smart way of going about learning as well as growing at the same time and making money while you're learning. So I think it's a great strategy. So what are some of the biggest mistakes you've made over this journey of all the way from being an LP, jumping from LP to deal sponsor, and then going forward?
Yeah, I think the biggest one at the beginning, at least, was trying to find something in my local market. I was really intimidated about investing outside of where I lived because of this kind of control issue, if you will. It didn't take long for me to realize that Los Angeles is maybe one of the worst places to invest. You mentioned it is January 6th, 2023. We still have eviction moratoriums going on due to COVID in Los Angeles, if you can believe that. So if that doesn't tell you everything you need to know about this area, I don't know what will. But yeah, I was really intimidated. And I spent, I would say at least 6 months wasting time trying to find something that would cash flow, trying to find something that made sense, despite all the kind of tough government regulations we have here in this city. So not realizing the mantra of live where you want, invest where it makes sense was my first biggest mistake. And the second one, I alluded to earlier, was not teaming up with people soon enough. I really wasn't sure initially what I could possibly add to others being a newbie in this space. Why would someone want to partner with me? I don't have experience. I don't have a track record. That limited thinking set me back at least a year. And thankfully, I was able to get out of that with some coaching and mentoring to figure out what value I did have. But yeah, trying to do this on my own when it truly was a team sport was a big fail. I'm a big college football fan. I can't imagine just being a quarterback and that's the only person on the team. Simply doesn't work. So I would say that. And then I think the third one is really understanding property management. I don't know if it's necessarily a failure, but more of an area of opportunity of truly understanding the difference between how property managers think versus how asset managers think, because they are truly two different things. Property management companies are incentivized one way, typically on revenue, or maybe, you may bundle in other things as an asset manager to incentivize your property management company, but they do not have the skills or experience, or I would even venture to say the incentive to care about kind of overall portfolio performance, return to investors, et cetera. So that was another big learning opportunity for me.
That's good. Or controlling costs has been my biggest pain with property managers is controlling the spending.
Yeah, it's tough.
No, it's good. So what advice, as we kind of wrap up here or start wrapping up the show here, is what advice would you give your 20-year-old self?
Oh, I love that. Start earlier. I was really on the path in my 20s of getting a bigger, badder W-2 because I thought it's what I needed to do. I took 2 years off of my lucrative career in my 20s to get my MBA. Again, it wasn't to be an entrepreneur, it was to move up the corporate ladder. And I just wish I knew this concept of not having to trade time for money and earning passive income earlier, but I just didn't come from a family or live in an area where that was even a thing.
All right. No, I like that. As we kind of move away from the actual, nut and bolts of the investing, what's the why behind, why we're doing with the entrepreneurship of growing your real estate portfolio? Is this freeing you up so you can spend your passions somewhere else? So what is that? What's the why behind this? And
Yeah, so I have a dual why. I alluded to earlier, I have a health condition called cystic fibrosis. If you're not familiar with it, it is basically a lung destroying disease that I was born with. And when I was born in 1981, I'm 41 years old, I was supposed to live to be 8 or 9 years old. And thankfully, that hasn't been my fate. But I always wondered and wasn't sure how long I would be able to trade my time for money and earn income to support myself. And the last thing I ever wanted to do was to be dependent on my family, who had already sacrificed so much raising a disabled child. So once I understood I didn't have to trade my time for money and I could have money, come into my life while I slept or while I was in the hospital battling the endless number of pneumonia cases that I've had throughout my life, that was really a game changer and an incentive to generate passive income and build this portfolio. Around 4 years ago, a new miracle medication came to the market for CF and really gave me my health back. So now, ironically, I have the ability to trade my time for money because I have great health. So the next version is, yes, my husband and I are so excited to be able to be involved in charities here in Los Angeles, specifically after school programs for inner city children, and to really make the world a better place. We live pretty humbly here in our own little 2-bedroom condo here in LA. We don't need a lot to have a great life, but to have this abundance and to be able to give back to the world to people who, weren't born as fortunately as we are, is a massive driver for us and something that motivates us every day as we work in this business.
Beautiful. Love it. Love the whys. Because it really, the whys are what drive you. Especially being an entrepreneur, it's definitely every day is a roller coaster. I go through the swings that I go through every day.
Yes.
As the calls come in and fires I got to put out. And it's those whys that keep you pushing forward and, keeping you from, sticking your head in the sand and really, so that is really good to see people that have really strong whys behind their actions and motivations. All right. So now we will round out here with the that fire round, as we call it. So a couple of quick questions. First thing that comes to mind. What is the best book that you recommend other than Rich Dad Poor Dad?
The Creature from Jekyll Island by G. Edward Griffin. If you haven't read it. Yeah. It is it reads, but it's stranger than fiction. It starts off a little slow, but I promise it'll be in the top 5 books for any of the listeners that you've ever read in your life. It's that eye-opening. I
read the children's version of that like 2 days ago with my daughter. It's Tuttle Twins has the kids version of it. And it is really good because I was trying to explain her what inflation is like, or what inflation is, because we just went to Costa Rica and their money there, they have colones, and you can get 10 million colones is worth like $17 US. Yep. And it's really hard to try to explain that to a 10-year-old of, they're holding a $10 million bill in their hand. And I'm like, we can get a couple of cheeseburgers with that. And so I was like, I got the perfect book for this. So The Creature of Jekyll Island was that book. They're at least the kids version of that book. So great recommendation.
Yeah.
What is your superpower?
I think connecting with people. I feel like everyone is a friend I just haven't met yet. Everyone has a story that I'm always fascinated to hear. So being around people, helping to understand them, what motivates them, and ultimately doing something that can be able to help improve their lives is definitely my superpower.
All right, great. Love it. And we already talked about the biggest lesson, or maybe not. What's the biggest lesson you've learned over your career?
Ooh. Yeah, I would still say, things are a team sport. Things are better together. You can go faster, further with a team. And I think having a team mitigates risk tremendously as well.
Okay. No, that's good. I concur. And for the busy working professional who is working toward their financial freedom, what advice do you have for them?
I would consider passively investing as someone that did that first. And, for some people, they don't ever want to leave their W-2. They don't ever want to be a real estate investor full time. Definitely consider, if that could be a benefit for you. Some of the benefits, as you said, include that financial freedom and being able to invest in various diverse markets across the U.S.
Love it. For our listeners that are listening to this, how can they reach out to you? And do you have any asks of me or the listeners?
Yes, of course. Well, I'm very active on LinkedIn. I lead with that kind of go-giver mentality. If I try to provide as much information, education, and inspiration, if you will, on LinkedIn. So you can definitely find me there. And then I'm also at sylviscapital.com. It's a little bit of a funky spelling of my last name. So I'm assuming, Vince, you'll put that in the show notes.
Absolutely.
If you throw a backslash on that website, sylviscapital.com/webinar, you can learn a bit more about us, how we think about this space, and get to know us better.
All right. Sounds good. And I'm looking at the website right now, and I will absolutely throw that in the show notes. Well, this has been a very fun, energetic show, and I thank you for that. And we'll look forward to seeing your next 1,000 units this year. So
appreciate you, Vince. Thanks for having me on.
Yeah, absolutely. Bye. All right. That was an amazing show with Amy there, overcoming her own personal battles with her medical conditions that she's had, still able to, like I said, overcome that, thrive with that, and amass a huge portfolio, $96 million in just 3 years of actively investing. She had about 10 years of passive investing before making the active side, but that is a huge jump and very inspiring to see that that level of motivation to go out there and then turn around and get back to her community as a big cause or a big why for her. So definitely reach out to her, follow her, like you said, on LinkedIn, and always excited to see the growth in her journey as she goes along. For us, Tri-City, if you like what we've been doing, we'd love to have you join us on some deals as well. Come out, see what we're up to. So definitely check us out, tricityequitygroup.com. Big news is we just started doing the marketing and selling tickets for our next big event out in Hawaii, the Hawaii Millionaires Mindset Conference, the Blueprint 2.0. The first one we did last June was absolutely phenomenal. We had like 280 people show up. A lot of them flew in from the mainland, as we call it, out to Oahu, Four Seasons, had an amazing few days out there, weekend out there. So much so that we immediately started planning the next one as soon as that one concluded, doing it bigger, better. And this time we're doing it at the Big Island of Hawaii at the Moana Kai 5-star resort out there. It's going to be phenomenal. So you want to check that out, the Hawaii Millionaires Mindset Conference. Bring your family. I'm bringing mine. We're going to stay there for a week and turn education, networking with vacations, mold the whole two, bring my family along, see what I do. In the real estate and everything like that. And it's going to be a blast. So I want to see you out there June 2023. So just a few months, about 6-7 months from now, we want to see you out there. All right.